All right, we're gonna do a little orientation. I know some of you guys have already I mean, you guys price out loans in Optimal Blue, and
recording?
yeah,
Okay.
and you go through you can go into your internet browser to just kind of get an idea what the pricing is. But when you lock a loan, you actually have to do it from it within Encompass. So you can't go into Optimal Blue in your web browser and lock it from there. You have to do it from within Encompass. So I'm gonna go ahead and pull a file that I think's getting close, or we could potentially lock. It's one of Joe's loans.
Are you going to talk about like best practices on locking rates?
Yeah.
Okay.
Let's talk a little bit about that.
Okay. See, guys, let me explain. When you lock an interest rate, you're reserving the bank's money for that loan. Okay. So generally, we only really want to lock rates, once you have a conditional approval. Or
right.
I mean, is that when you feel comfortable to do it?
There's in some situations like right now, I know that the market's kind of shaky, so it might be a good thing if you have if you're competing for a deal where you're offering a particular rate, that loan's locked at the time that you send the disclosures out. So yeah, if you're competing with another lender for that deal, or if your ratios are tight, or and that rate makes a difference because from what it looks like rates are going to continue to go upward, at least right now.
Yeah, but also, like, for instance, what's happened recently in the interest rate market is it's rare that happens. It happened. The last time this happened was in 2012, and then 2009. So this is not something that you see where you see the 10-year yield move 70 basis points in a month. It's very, very rare to see that. And how you can track interest rates, if you guys are curious and want to educate yourself, just watch what the 10-year yield's doing. And so the 10-year yield tracks, the mortgage rates. And so when the yields are going up, that means that interest rates are going up. Right now it's at 2.3, I think 2.25.
Yeah, 2.3, something like that.
Yeah. So that means that if that's going up, that means that mortgage rates are going up. If that's going down, that means that mortgage rates are going down. So what does that mean to you and your customer? Well, if you want to try and time the market, let's say you log in the morning, you see, hey, the 10-year went down. Oh, this might be a good day to lock rates today. If you see a sharp decline, this might be a very good day to lock rates. I'm going to tell my customer, instead of 4%, I can give them a 3.5%. So yeah.
Question. One is, the longer we lock a rate, is there like a cost that we incur by locking the rate 30 days in advance as opposed to maybe a 10-day lock?
Yes.
Okay.
Yeah, the locks are in 15-day increments, so you can do a 15, 30, 45, or 60. If you go out, the further you lock a loan out,
go to the 52-week on the chart.
But extensions don't have increments, right?
You can do extensions per day. Yeah, it's a eighth of a point for a 5-day extension.
Okay. Yeah. Anyway, you guys look at the chart right there. So today the 10-year is at 2.33. You see back in July, it dropped down to like 1.45. So you're right now you're at the year-to-date high for the yields.
And you guys are looking at the rates in the 4s, and you're probably like, oh my God, this is horrible. They're actually still pretty good. You guys have been spoiled because if for some of you that came in the industry looking at 3s, that was freaking good. But selling rates in the 4s is no different than selling rates in the 3s. It's all a matter of a frame of reference.
I will say this though, guys, if you're dealing with customers, especially A-paper customers, you need to have that rate float lock discussion with them, because if they're under the impression that you're locking their rate in, then you need to have that conversation with them, because if you go to closing and the rate's 0.5% increase, and he says, Mark, you're supposed to lock my rate. What happened? So you don't want to get into that conversation with the customer because he thought you're supposed to do something. So you need, if you're dealing with these loans, some of these people that are very rate sensitive, bigger loan amounts, or very good credit customers. If you have an agreement up front, like we did with Marcotte, which was Jason's loan, and we told those people we're going to lock the rate in, then we got to lock it in. Okay, if that's the deal. So don't play the market and think you know what's going to happen. Nobody knows what's going to happen. So
right, so on those deals you want to try and you want to lock them up front if that's the commitment that you're going to be giving to them. But anyway, the trend is it's not a direct indicator, but it's one of the indicators you can look at to kind of see where rates are headed.
You do like a float down rate, like where
No.
it drops. Like when we lock it, that's the rate they're stuck with, right?
Right. That moment, that day's pricing, that moment pricing is the one that they're stuck to.
okay. Now what about with with price improvement? There's a 0.5% price improvement. Are they not?
If there's a
They
0.5%,
they want to do a renew.
I don't know, maybe.
What if you let the rate expire and just, if the rates drop down from what it was?
It has to be expired for 30 days.
30 days?
Yeah, and then you can relock at current market. So if a rate lock, you lock a rate for 30 days and it takes you 90 to close it, it might be best just to let the rate lock, just let it expire and then wait for 30 days and then relock. But one of the things that's tracked pretty closely is the your lock fallout ratio, which is the number of loans you lock and don't deliver or close. So that's tracked very closely. A good loan officer is usually about 90% plus of the loans that they lock, they close. The minimum is 75.
Those are like good clean loans.
That means that you're locking. If you lock 10 loans, you have 10 files. You lock all 10. 9 of them close. If you lock all 10 and 5 of them close, something's wrong. It means you don't. It's either you're bringing in loans that don't qualify, or there's other problems. So the minimum is a 25. It would be 7.5 loans that you would end up closing. 2.5 fall out. So 75%. Does that make sense?
Mm-hmm.
Yeah.
So it's like a batting average or whatever you want to call it.
You get to that point where you're locking the rate, you got a farm, that moment.
Right. Right, but as a newer loan officer, sometimes you respond to the pressures of the consumer, and maybe it's a $60,000 loan and it's a 600 credit score, and that's the customer's pressuring you, so you're like, and you're not, but you have to be able to say, look, we need to get all of your documents in to make sure we're not going to have an issue here, because you're making a promise to deliver when you lock that loan, and you have to try your best to make sure you're going to come good on that. So the 10-year, you can just look it up on Yahoo Finance. That's where I look it up at, or CNN Money, and or whatever, and you can see where it's going. So once
Like a library index,
the Fannie Mae 30-year. There's an index for that. Not an index, but there's a graph for that one too.
The library is the lender offer rate. That's the bank thing. That is basically all the banks that lend to each other. That's the rate they pay for overnight funds. So it is one of the indexes that's used to determine some of the rates that lenders set up and we'll add margin to it. But this is basically the 10-year yield is used to track mortgage rates and the 10-year treasury notes. So basically what this is telling you is that the federal government is paying 2.23% to buy T-bills, 10-year notes. Okay? And and that also tracks mortgage rates. It's a very has a very high, the 98% correlation between the.
What, does this have a symbol or 3 letters? I can pull up one.
CB, was it CBOE?
The future market is /DN, but I don't know what it is. TDX,
Hold on.
I just know the futures.
Treasury yield.
Yeah, I thought it was a CBOE.
I'm not exactly.
CBOE? No?
TNX.
Oh, TNX, yeah. TNX. Okay. Does everyone understand what it means to lock a loan? Okay, that we're you lock a loan for $250,000, that we lock that money up and aren't going to use it for anything else. We're going to keep it set aside. Here we're using this for Joe's loan, 250 grand right here, and Joe wants it within 30 days, so we're going to have to keep it set aside for him for that loan. So that's a lot of money. Imagine if you're locking, everybody in the office is locking loans, and you got millions of dollars locked, and we don't deliver. They're going to be pretty pissed because they could have done a lot of other stuff with that money. You know what I'm saying? Okay.
So this is a huge responsibility. That's why we don't allow you guys to do it right now, but as we expand and grow, Josh can't lock it. Josh can't lock it alone. So you guys need to learn how to do it. So that way, when the time comes, and the time's locked, and you're able to lock it in. So at the beginning, you're not going to lock it alone, and you're still going to lock authorization.
Okay.
But it allows you, I'll tell you what though, most banks don't let loan officers lock loans. So it is a very good privilege because now you have the ability to see the loan officer issue on your approval letter and lock your own interest rates, which will give you more negotiating power. All through that. So that's a very powerful tool in the long run if you get more and more skilled and more versed. Hey, that's a lot of very money. Well, so it's pretty powerful. So,
And you can send them a rate lock commitment. You want to see that, you send that with a pre-approval order, that's a good way to lock someone in. I'll give you a rate lock commitment.
The pre-approval?
No, I'm saying like,
All docs are in.
No docs.
All docs must be in.
all docs have to be in with a rate lock commitment.
Now, if you don't lock a rate up front, when you send out your disclosures, there's actually a disclosure that's in the package that the borrower e-signs. Is called a rate float agreement. If the rate's not locked, every borrower gets it. It's just acknowledging if the rate's not locked, can change, The only time, and that protects us in the event that, the market's rates change and say, look, yeah, you had a rate float agreement in your disclosure package. Did you not see that? I never told you your rate was locked. Some borrowers are, they think that because they start off with one rate, even when you pre-qualify them months ago, they think that that's the rate that they're going to end up with. And they, one of the things that you have to help them understand as a loan officer, a good loan officer, is helping them understand that the rates are based on, market fluctuations, and they can change several times a day, once you set that expectation with them, you shouldn't have that kickback later on. And so the timing is important. If you lock a loan at the when you're sending out disclosures, as if it's like a solid file, like Marcotte was a really good one. You had the refi Almonte, which is like it was just so easy. And usually you'd probably want to lock them for an extended period, like a 45-day or 60-day lock, not on a 15 or 30. And the only time we do a 15-day lock is if you're resubbing the conditions for CTC. The timing is very important. So if you do a 15-day lock and you just got conditional approval, and you think I can get these conditions in 15 days, but it ends up taking longer to gather documents from the borrower, now your lock you have to extend. You could very easily on a $300,000 loan add, just for an extra, 10, 15 days, add an extra $1,000 in costs or so.
So how much does it cost to extend? Quarter?
An eighth for every 5 days.
Ooh.
So that's a quarter for 10. What is that on 300,000?
750.
750? Oh. So timing is very important, and the length of the lock, the duration, right?
I'm just checking my short recording. Okay.
Okay, so all you do is you go inside of a file, you go to Services tab right down here,
Go to Services tab.
and then click Search Product and Pricing. And Optimal Blue will not pop up automatically if it's your first time. We got to set your credentials in there and hit Submit.
Question? You know,
What's up?
I know it costs to get an extension, but if we set a 45-day lock and you close in 30 days, we're good as long as that's just like the extent.
Right.
Right.
Yeah, you actually on your lock you have to close by the last day. You don't have to fund. You have to close.
So you don't have to fund.
No, you have to. The buyers have to close that day. So if the seller signs the next day, the loan doesn't fund until the next day. As long as the buyer closed the day before, then you're fine on your lock expiration. That makes sense?
So this is a Desmond O'Neill file.
So you got in Optimal Blue. I don't know if you guys can see this very well. I'm going to turn off that other light.
Yeah.
I can't really resize this here, but anyway, these little red asterisks are required fields. The ones that really matter is like your first lien amount, and all this data already populated from Encompass, so I don't need to do any entry. When you're going inside Google Chrome and going in through a web browser, you have to go in and type in all your data. So it already populates everything for you.
Even long time.
Yeah, everything that carries over from Encompass. Sometimes the credit score doesn't carry over, but it's already got everything in there. And then automated underwriting system, this little drop down. So if you're using DU, which is what this is an FHA loan. So we're going to select and hit submit. All right, so there's our pricing. Now you'll notice a couple of tabs here at the top. This one says Best X. I wish we could zoom in this thing. All right, so this says Best X, and this is the pricing that we're on right now. Now, this is highlighted in orange because this is the rate that's in Encompass, not because that's the maximum rate that they qualify for, or that's the one that it thinks that is the best rate for your borrower. That's just because of what's in Encompass, okay? And it's saying this is the rate that you had selected, because that's what was in Encompass and carried over. So Chase, 3875, this is right here is your rate. It says Chase is the investor. This 30-day right here is your rate lock period. It gives you an APR calculation, which is really not really important for what we're looking at. This is the cost expressed as a percentage, which is 0.887. And this is the cost as a dollar amount, $14.98. Now let's go down just a tad. We're going to look at the rate of 4375 here. It's also a Chase 30-day lock, and this one has a negative 0.872. What the negative signifies is that that's a credit. The positive, the one that's a lower rate, the 3875 at the 0.887 is reflecting a cost, whereas the 4375 is reflecting a credit. The dollar amount of that credit's $14.73. Anyway, when we look at locking this deal, one of the things that I look at, and the reason why I can't just go in here and pick the rate and hit boom, go, is because there's more to it than just locking the rate itself. And it has to do with the structure of the actual loan, right? So I take several things into consideration when I'm locking a rate. One of the things that I look at is what are the ratios and where does the rate need to be at? The other thing I look at is what's the borrower expecting and how much money does the borrower have? How much money do they need to bring? So let's look at, I'm going to go click loan here, go back into the loan. I'm going to look at a few things. I'm going to go down to the guy's asset section. I'm going to look at his assets. See this? It says he has $8,400 in the bank. But what this tells me is that, because the processor probably updated this means that I got $8,400 that this guy can bring to closing if he doesn't need reserves. So now what am I going to do? I'm going to go down to details of transaction down here, and I'm going to look at the cash to close down here. And it's in letter P, 8664, right? So you guys see that? So what I'm going to try and do now is say, okay, look, how much of a rate, what rate do I need to pick to keep this guy's cash to close within the limits that I'm constricted to, right? So my limit is how much he has. And he has 8,400, but he's maxed, right now he's at 86, according to this. So I know I'm gonna probably need a little bit of a credit, because if we give him a par rate, if we give this guy a par rate means there's no cost. So a par rate on this deal was right here, 4.25. See how it has 0 there? And see how the price says 100? That's a par rate. That means there's no cost, no credit. So if I give this guy a par rate, he is going to be short a couple $100. Now, who comes up with the extra couple $100? It comes out, we are going to end up having to credit to him, right? And I don't want to do that. I don't want to lose money on the loan just so he can have a par rate. You know, unless I have to. So what I would do is probably go up a little bit to the next rate. But before I do that, this is just a glimpse. You know, I'm just looking at cash to close here. Now, what I actually do is go and go and look at the itemization and trying to see if there's anything that stands out that might be incorrect. I also double check the insurance and taxes, because if the insurance is lower or the taxes are lower, that could impact your estimate. You know, right now it's $8,600. This deal's in New York. And so I know that the fees are going to be you got high fees in New York. So it's got his homeowner's insurance for a full year. Right here on line 903, it says $1,319. I'm just making sure everything's accounted for. Now it's got 9 months of property taxes in escrow here, line 1004. 9 months now in New York. If this had a 2 in here, I would have known that the loan officer probably was estimating way low, because in New York and Pennsylvania, there should be probably anywhere from about 9 to 13 months worth of taxes being collected, property taxes. And that's something we have to look out for. So if this was a 2 here, and I lock this loan at a par rate, right, because I think my cash to close is really low, what's going to happen is that I would have miscalculated on my estimate and not accounted for property taxes. So when this loan goes to closing, we're going to have the closer going to account for the correct amount of taxes, and now his cash to close is going to go through the roof, right? You thought you had more room to play with than you actually had, because we're not looking at the estimate correctly. So it's important to take, you know, something like that into consideration. Anyway, the guy's got 9 months. I think that's reasonable. I think we're going to, just leave it at that. And then it's got title fees all in here, and everything else looks good. Now, just in case, in my mind, it's got some 11 under credit right there for 1,000. That's, I don't know what that is, but that's not, I should not have that there. Let me take this extra lender credit out. I didn't notice that earlier. All right, so now there's a cash to close. We took that. Let me make sure that lender credit didn't go out on the initial LE real quick. Okay, see right here in this section, it says lender credits. It's empty. That's what we want on your initial LE unless it's locked. If that $1,000 lender credit was listed there when the disclosures went out, we have to give it no matter what. Even if the rates, whatever it is, we still have to give them $1,000. So that's good. So that's a good thing to catch, that there was a $1,000 lender credit added here. Maybe someone was just trying to estimate something or something whenever they were going over, maybe it was just added for a minute and they didn't take it out. But really, we're going to need roughly, I said, $2,600 credit, get him down to 8,000 or lower. He's got 8,400. Leave a little cushion. So this one here he's probably looking at more like 4.5, 4,625, somewhere over here is what we'd be looking at for the rate to get his cash to close to within the limits that he currently has. Now I could say, hold on a sec, I'm not going to lock. Let me check with the processor. Let me just make sure, see if there was any more money the guy had. Maybe he has 10,000, so that way I can get him a little lower rate. It just depends on the deal. So it's unique. Each one's going to be a little different. DTI. So
He's got the room now.
this guy's DTI has got the room. Like Danny had a loan. Danny has got a loan processing. I locked today. Borrower had, the rate went up, but borrower had like 5,200 in the bank or 5,000. We had to give her a pretty big lender credit to get her cash to close down within that limit, unless she comes back and says, "Look, I got more money. I'd be happy to pay for a lower rate."
And I guess the locking all rate, that's a conversation we have to all.
Right. So usually you can give them a couple of options. If if it was me, I'd probably say, okay, here's this option, 4,625. The cash to close was going to be around $8,000, and that's what you already have verified. If you want to go with a lower rate, you could do something like a 4%, and your cash to close is going to be X. Now, if we go with the 4%, this is the deal, okay? I want you to realize this is your job, is to make sure they understand the consequences of their choice. So if they choose, they say, "Hey, look, I'm really interested in going with the lower rate." Well, let me explain to you what's going to happen, and that's fine. You could do however you want. This is the consequences of that. Go with the lower rate, but look, we only have 8,400 verified right now. You're supposed to close next week, so this is the deal. We're gonna have to verify you have more money. And that means that we have to go get an updated bank statement from you showing you have these funds, send it back to underwriting to review. Now you're closing next week. That's going to get pushed back probably another 7 to 10 days. So that's not going to happen, or whatever, because we have to go through these extra steps. Now, any deposits you have in your bank account that we don't know about, when we get your updated bank statement, now are going to come into question. Then you have to document and support those. We have to go through a little bit more paperwork, but hey, I'm willing to do it. Is that something that you would like to do? We need to check with the sellers too to see if they're willing to extend. They might charge a fee to extend. I don't know, but we would have to talk to them to see what's up. So if you want to go with the 4%, there's going to be a little more work involved. In my opinion, it's not worth the money. The difference in your payment, the risk of extending beyond your close date, is not worth it. And you can even go into an even deeper thing about what's the time to recoup the cost, the break-even point. It could be in most of the time, depending on the cost difference. If it's $3,000 cost difference, depending on the size of the loan, you're probably looking at somewhere between year 3 and 5, or something like that. But you can actually calculate the differences in the payment, how long it's going to take to recoup the money, and say how long are you even going to live in the house. You're going to live in the house for over 5 years? If you're not, then go with the higher rate and save the money now. You know what I'm saying? If you plan to live here for 30 years, then yeah, take the lower rate and go through the trouble. Anyway, that's the consequences of something, you have to, and sometimes, some of you guys I'm telling this to right now, it's going to go in one ear and out the other. And you'll only learn when you run through the problem itself, and the hard way.
I had a conversation with literally today, because that was one of the questions. His question was, am I still going to go to 2.875? That's what it's still approval. I know you said it's not locked for the rate to change, so we had a conversation with him.
Yeah.
To let him know that, hey man, we have a new president elect, and there's a lot of uncertainty. And it's not about Trump or anything else, but whenever that happens, there's a lot of things that happen in the markets that the rates are going up, and right now the rates are going up. So, if you want the rate, you have to buy it down, and you may not be able to do that. So he already asked me, I understand, all I want to do is that, can I be in the conversation when, if I can make a decision of what would be the best way to go.
Yeah, no, definitely. But yeah, it's your job is you can give them an option, give them their option, A and B, and you don't have to go over every single eighth of a point. These are all an eighth of a point increments, right? You don't have to go over every single one. This is $200 more, $300 more. You can pick two rates. Here's the cash to close that's going to work, and here's one that's going to take a little bit more. And if I looked at the graph, this chart, right? 3875 is costing 1,500. 375 is costing 2. 3625 is costing 46. If you look at that, right, what's the common sense choice there? Where would you not go below? You probably wouldn't go any less than 375. Which is, because if you go to 3625, it's going to cost you $5,000. See that jump in price? So you gotta look at, okay, so there's no point even really going to that, because the cost is too high. So 3875, difference between 38 and 37 is $500. I'd probably show them the 375, maybe the 38, and then the 46, and because I know that the 46 that is going to work. I can make that work. Anyway, to actually lock the loan is the actual process of doing it is very simple. All you do is click this little blue button over here and click lock. It's kind of grayed out because the pricing desk is closed. It's open from 9 to 5 Central Time. That's the time period that you can lock rates, Monday through Friday. So after 5 o'clock, you lose that ability. We'll cut you off that second when it clicks to 5. You click that, and it pops you up to a summary page. It says, "Are you sure? This is your pricing. Just make sure you got the right rate, and hit submit." Even if you get the wrong rate, you're locked into that day's pricing. So if you're uncertain, someone says, "Hey, just lock me in," just go ahead and hit lock on a rate. You can always go change to any other rate, and on that day's pricing, it's to go get that price. You know what I'm saying? So if you're uncertain of a particular rate, that's one thing that I'll do. I'll just go and just straight up go lock a few, then go back and figure out later, and then make some changes. If it's like getting toward the end of the day, I got a bunch of locks to do. I got like 30 minutes. Instead of trying to analyze every single one, if pricing is good, I'll just go lock a bunch and then go back and figure out and just request changes later. You know what I'm saying? Okay. You can request a change anytime, as long as the lock's not expired. Yeah. So if I lock it right now today and I want to make a change next week, right? I can go make that change next week, and the pricing I get is from today. Yeah. That moment, yeah. Because it can change. It can change during time. Right. Now, keep in mind that when you're getting closer to closing, if rates go up, if there's a change in the APR over an 8, a new CD has to be issued, and or LE, obviously an LE, but the new 3-day period will be required. So let's say a CD goes out at 375, and you want to change the rate for some reason at that point, and the 3 days is already weighted, and they get to closing, and they say, oh, hold on a second, it's cash flow is too high, and then you got to go back and change the rate. The 3 days starts over again. It's business days with the Saturday, no Sunday or holidays.
Like Lilibet was come on bid.
Mm-hmm.
She wouldn't. If she didn't sign this, she could sign that.
She can the LE,
Yeah.
the LE she can sign, but I think that's a little bit different.
And the rate lock is weird.
Yeah, but I'm talking about her CD.
Oh, I see.
I'm talking about when the CD goes out, then you have to wait 3 days to close
Oh.
from the initial CD. It counts in the time period, but no, we don't close on a Saturday. I haven't seen a loan close on a Saturday in a long time. And the only reason why a loan closed on a Saturday is because there was an attorney that we used to do business with, and he charged some good money to do it. So anyway,
So really, that's my question. Is there a period of days that you have to sign the rate lock?
no, there's not a period of days, but like what we're running into a lot lately is that after we lock a loan, if the initial disclosures have already been sent and the loan wasn't locked at that time, and then later on during the loan process we lock the loan, we have to issue a new estimate, and we send that new estimate out with a change of circumstance. A change of circumstance is a document that explains the difference between what happened from your original estimate, what the change was that from your original estimate to this one, what changes occurred that why we're issuing you a new estimate. Okay, so this document explains to them your initial interest rate was this, your locked rate is this is why we're sending you a new estimate, because your rate was locked today. Anyway, the borrower is required to sign that. It's important that they sign it. Hope that within hopefully the same day or the next day that they receive it. Only for the reason that sometimes when a loan gets to closing, if we're missing that document and they sign it the day that their closing disclosure is supposed to go out, it'll delay the closing disclosure an extra day. Anyway, so you'll any question on locks up to this point? Huh?
Very simple.
Okay. So if you do a lock on a really good loan at the time you send out disclosures, how long are you going to do it for?
45.
Okay. Let me show you a USDA real quick. What's a now when a loan's locked, you'll actually have this little blue lock on your right here, and these will have the number of days until expiration. I think this is a USDA that I locked. Is it?
No.
Is it FHA?
What?
That's the goals of Alberto.
Okay, so this deal.
Somebody was sleeping?
Yeah, like orthodoxies.
Okay. So this is a USDA loan. This loan, when I went to lock it, I looked at the borrower's assets, and I saw that the assets have the $311. The cash to close was 4,000,
Holy shit.
and they had no concessions, right?
Who did that loan?
But anyway, the house, it was anticipated the house would appraise for more, and the house appraised for 55. The sales price was 48. So what I did, one of the things that I looked at is that it's usually better to increase the loan amount, like on a USDA loan, because we have the ability to. I can arbitrarily increase the loan amount on a USDA loan without any changes to the contract, no problem, as long as it's equal to the appraised value or less.
Let me just say this, guys, just a quick note, please do not bring in any $48,000 loans in. Okay? Yeah, please do not do that.
You said you can, just on USDA, you can go, then on FHA? No.
Right. No. UFHA, you have to. That has to be negotiated in the price of the house in the beginning. But with USDA, I can take the house appraised for 55. So technically, I could take my loan amount to 55, the base loan amount. This one right here.
You can get all the money.
No, well, no, I can't go. I can't go up that high because I don't really need to.
Yeah.
There's not enough expense for me to do that.
They can get refunded for their earnest money appraisal though.
There's still any sort of like 6% cap.
No, not on loan amount.
Can you use that for anything? Can you use that to buy down the rate? Or?
Yeah, and that's well, I mean, I gave this lady a low rate. I mean, you would have thought that this loan would have probably got a rate in the 4 worse.
So any USDA that breaks over, you just add this to the loan size to buy down the rate. If you want to.
Yeah, if it appraises. Now remember that when it comes to ratios, and it's kind of like a really, I think it's more like an art. It's kind of fun to see because you can, if you try and say I'm going to try and you need to get the rate down to get the ratios to work. And if the house appraises for more, that's a perfect opportunity because then you can take the loan amount up. An increase in loan amount has less impact on your principal and interest payment than an increase in rate, right? So decrease in the rate, increase in the loan amount is you get a better improvement in your ratios, right?
Yeah.
So it gives you, could help you get a loan qualified if something came up. And sometimes that's worked out, where a house is appraised out. But anyway, what I did is I added a negative down payment, and it's called down payment, but just ignore that. There's not really a down payment on a USDA loan, and no, the borrower doesn't see the negative 4,500. That's just internally. That's what we see, how we see it. The borrower, all they see is the loan amount. So I increased the loan amount by $4,500 and locked her at 375. Let's take a look at the lock though and see what the credit was. I locked this prior to election. Shut up. I liked it 48,000 instead of the.
Exactly right.
Anyway, they're getting a credit of 5.15. I could have gone up higher, gave them a larger credit from the interest rate, but if I have the ability to do it in the loan amount, I'll take the loan amount over the rate. So we did that. We increased the loan amount up. It took her cash to close to negative 400, and I leave a cushion. I don't ever get it to zero, because if you plan for your cash to close to be zero, it's probably gonna be over. And we want to leave a little cushion. So if it happens to be that,
So the next question.
and she could get up to $500 in cash back on this loan. This is USDA. She has $500 in earnest money. So those, I'm looking at, if I put the cash back to borrower at negative 1,500, that's way overshot. But at negative 400, it's within the amount that she has in earnest money, so she could potentially get some money back. It's not way over the 500 she has in, and it's not zero or more, so it's not going to cost us stuff because she doesn't have much money to bring. What's the question?
I think I answered my own question. I think like with realness,
Mhm.
I think the debt to income ratio is too tight. Do this for.
I mean, if you're within a percent, you can maybe work something out. I don't know how far off he was.
What are you trying to figure out?
I was trying to figure out if we could have did something like that for realness. But I think the debt to income ratio is the reason why we did.
I don't remember the
That's reason why we
specifics.
swapped the FHA. When I got him, I mean, we got, okay, if you come with $1,000, it might be a fee.
Well, the reason why we did it like that was, yeah. But even by now, they still, we're that, drop, we already have, that was the rate below, lower.
Did he have an appraisal in?
No.
So at that point, you're betting on something that is really uncertain. So if the house doesn't appraise for more, you know what I'm saying? You don't know that until the appraisal comes in. So that's a risky bet.
That it makes sense now.
Yeah. Yeah. All right. I think that's all we needed to go over tonight.
Good stuff to know, man.
All right.
Thank you, John, that was very good.
So it's gonna be a team viewer, Josh?
Yeah.
Awesome.
Very nice.